Welcome to Illuminati Silver. We tell you the truth about silver. Today is Wednesday, the 20th of May 2020, and on Monday we published a video entitled Gold and Silver Rose and Then Fell Back. Why? And on Sunday, why serious investors and advisors now recommend gold, and on Saturday, of course, our Gold and Silver weekly update for the weekend in the 15th of May. Now, we've placed links to all three of these in the description box below if you haven't had an opportunity as yet to watch them. Now, on Monday, we noted that from the opening, gold opened strongly up and at one point rose to $1,765. And then at the time of writing that article/video production, which was 2013 GMT plus 1, its price had fallen back to $17.34. Silver, on the other hand, had performed considerably stronger, rising not only above $17 but peaking at $17.57 at one point, though it did fall back to $17.10 at the time of writing, but still some 43 cents higher than its closing price on Friday. We then gave the technicals for gold and silver by stating that the main trend was up, according to the daily swing chart, and the minor trend was also up. So technically, silver had and still has support at $17, an extremely strong support at $16, and any rise up to and beyond $17.50 again will quickly move to $18, though there'll be some vacillation because it takes some time for it to get there. But we also pointed out that there may now be a temporary pause in view of a not inconsiderable rise in equities, though yesterday they were hit a little. Now, at the time of producing this video, gold is standing at $1,744. That's $10 more than it was when we quoted on Monday, and silver at $17.34, 24 cents higher than we quoted on Monday, both appearing to be on a gradual ascent once again. Now, there are a number of reasons for this, not least being a slight reduction in the value of the dollar, as the dollar index has fallen to 99.35, plus, as we forecast in recent videos, additional news from financial institutions either actually putting into place, or promising additional stimulus measures to the world's economy. Now, whilst short-term this may help equities, though the markets are undecided at the moment, it's also conducive to higher gold prices, and silver then naturally along with it. So let's take a brief look at some of the articles published today, which is helping to cause gold and silver's rise. Bloomberg article dated May 20th, 2020. Headline: ECB hands banks $931 million in first round of new funding. The European Central Bank doled out €851 million, or $931 million, to euro area banks in the first round of a new liquidity program launched last month, according to a statement. The allotments with a 16-month maturity were made on Wednesday under the ECB's so-called Pandemic Emergency Longer-Term Refinancing Operations Plan, or PELTRO. The facility mainly targets smaller banks and those who aren't eligible for a separate program with targeted lending criteria. PELTRO loans are subject to an interest rate 25 basis points below the ECB's main refinancing rate, which is currently at 0. That means banks taking them can make a profit. The program was launched last month amid a rapidly deteriorating outlook for the euro area economy. A separate program known as Targeted Longer-Term Refinancing Operations offers banks even more generous terms in return for providing credit to the real economy, though the next allotment under that facility doesn't take place until June. The relatively low take-up of PELTROs suggests banks are waiting for those loans to become available, according to Danske Bank chief strategist Piet Christiansen. End of article. Bloomberg article dated May 20th, 2020. Headline: Negative interest rates are last on Bank of England's list, Barclays says. Cutting interest rates below zero is the last policy option the Bank of England officials would currently choose, according to Barclays. Renewed asset purchases, potentially with a tilt towards riskier assets, are likely to be the central bank's first choice, Barclays economists wrote in a report published Tuesday. They expect a further £100 billion or $120 billion of quantitative easing in June. After that, the Bank of England could cut the term funding rate scheme below zero for bank lending and ease accounting or capital rules to reduce the cost of making loans and bolster credit supply, the report said. Yield curve control, with explicit forward guidance to hold rates unchanged or lower over the foreseeable future, would be the final option before moving to negative rates. In the current phase of the crisis, negative rates are not the answer, the economists wrote. The Bank of England is right to focus on quantitative easing policies and financial marketing functioning, de facto enabling the government to deploy its policy response to the virus without facing jumpy or adverse funding conditions on financial markets. The debate over whether sub-zero rates are the right response to the UK's economic downturn has stepped up a gear in recent weeks, sending gilt yields tumbling as Bank of England officials emphasised that they would rule out nothing. The central bank has already slashed interest rates to 0.1% and restarted bond buying to fight the crisis, which it says may tip the country into its worst downturn in 3 centuries. So far, Barclays said, the comments from policymakers suggest that while going negative is a potential option, they see no need to cut just yet, and consider it a decision that would require careful consideration. However, the discussion implies that they see no specific technical issues that could not be negated. Governor Andrew Bailey will likely shed new light on his thinking when he faces questions from lawmakers later on Wednesday, alongside his colleagues Ben Broadbent, John Cunliffe and Jonathan Haskell. End of article. Bloomberg article dated May 20th, 2020. Headline: UK's first negative yielding bond sale sharpens focus on Bank of England. Britain sold bonds with an average yield below zero for the first time, intensifying a debate on negative rates hours before testimony from the head of the Bank of England. The UK Debt Management Office raised £3.75 billion, or $4.6 billion, by tapping existing bonds maturing in 2023. While the yield at minus 0.003% is little surprise to market watchers, given that the existing bonds were already trading at roughly the same level, what makes the auction precarious is the timing. That's because if Governor Andrew Bailey repeats his opposition to negative interest rates when testifying before Parliament's Treasury Select Committee on Wednesday, which is today, at 2:30 p.m. in London, buyers could see the value of their gilt holdings plummet. If he was overtly hawkish, yields on short gilts would be likely to rise, said John Wraith, head of UK and European rate strategy at UBS Group AG. But I suspect whatever he says will be aimed at reassuring the market and wider public that the Bank of England stands ready to do anything and everything it thinks could help if the economic situation worsens. Gilts have rallied this week after the Bank of England policymakers Andy Haldane and Silvana Tenreiro raised the prospect of further easing, with Brexit fears and the coronavirus lockdown pushing Britain towards its worst recession in 3 centuries. Yet Bailey has pushed back against negative rates, saying last week that although nothing should be ruled out forever, they were not under consideration. In March, the Bank of England announced it would add £200 billion of gilts and corporate bonds to its asset purchasing programme, expanding it by 45%. Barclays plc, which sees negative rates as the last policy tool the Bank of England would choose, expects a further £100 billion of quantitative easing in June. Adding fuel to the fire, UK inflation in April fell to the lowest since 2016 amid a drop in energy prices and an economic slowdown induced by the lockdown. This morning's release of the UK CPI inflation data shows that price pressures are way below where the Bank of England would like them to be. Jane Foley, a strategist at Rabobank. This adds interest into the debate about negative interest rates. While the nation's economic outlook is bleak, the sale highlights that the government's huge spending plans to support the UK hasn't spooked investors. That's largely thanks to the Bank of England's asset purchase scheme, which has kept the cost of borrowing close to historically low levels. If one reason why demand outstripped the amount of bonds on offer more than twofold, I'll read that again. It's one reason why demand outstripped the amount of bonds on offer more than twofold. Even though existing bonds due July 2023 saw their yield fall more than 60 basis points this year to 0%, Citigroup Inc. strategists, including Jamie Searle, say the issue looked cheap compared to peers with similar maturities. If anything, this also shows that despite the additional gilt issuance, there is still a structural shortage, said Antoine Bouvet, senior rate strategist at ING Group, NV. On Tuesday, investors piled into the UK's syndicated bond sale with orders for the £7 billion offering exceeding £53 billion. End of article. For those who listened to our video on Monday, we ended with the following words. Quote, "So to conclude, let us be confident about one thing. Both the Bank of England and Federal Reserve have regarded negative interest rates as truly a last resort, partially because of the intricacies and unique features of certain sectors of their financial systems. But if the Bank of England is now seriously considering it and getting the idea out there, then after Jerome Powell's comments yesterday, you can bet that despite protestations to the opposite, they will be considering it as well. And we can see from these articles how clearly the general directions from virtually all central banks to zero rates, negative rates, QE, and bank liquidity funding is moving. This serves only to benefit gold and silver in the medium term. There may be a delay between now and when their prices peak, as we saw between 2008 and 2011, but steady incremental rises do appear to be the blueprint, which precious metals are most likely to follow. What do you think? Do share your thoughts. Thank you so much for listening, and if you haven't already done so, please subscribe to our channel and press the bell sign so that you're notified of our videos as and when they are published. Not forgetting that we update our Richard and Greg channel every few days, and we have placed a new entry on that channel this very morning. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer. Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.